What's going on, everybody? That was one of the worst days in the market that we've seen in a while. We have some new statements from Tom Lee here kind of breaking down the markets. And in this video, guys, we're going to be talking about everything that's happening with the markets here, understanding exactly what is being said by these incredibly successful financial analysts, because in my view here, guys, there is a story that is unfolding in this market right now. And if you can understand that story, it's going to make it a lot easier for you to stomach some of these short-term drawdowns here. So guys, before we get into all of that information, if you guys do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot, spreading these videos out to as many people who actually want to learn. And make sure you guys are subscribed so you never miss another video like this. Now, we're about to get into this Tom Lee interview right here, some of the most important points, but I do have to give a shout out to all of the members of the private community here. Again, I'm going to throw some of the screenshots up of all of the amazing gains. This is like 7 multi-1,000% trades, or 7 over 1,000% trades that we have been able to nail in really just the last month here. Again, if you guys are interested in some of that short-term trading stuff, make sure you guys check out that link down below. Use code TRADE. You get your first month for 50% off. You get access to all the educational courses, the private daily live streams, the macro research reports, single stock research reports, the list of stocks and cryptos that are about to explode before they do. What else? The pre-market plans, everything. So I only have 5-star reviews for a reason, guys. So enough on that. Let's play the clip and get right into it here.
One of the charts that went around this week, including me spreading it, but like a lot of people were sharing that GDP Now chart. And I know there's some funkiness about the turnover from January to February with some of the data. Let's not take this as an actual forecast, but that's a pretty extreme drop. We went from a 2.8% GDP Now reading from the Atlanta Fed to -4.
Yeah.
Outside of the pandemic, can you recall a drop-off of that magnitude? Even if there are all these nuanced reasons for why it's data related and not, or it's a quirk of how they collect the data, it still seems extreme.
Yeah, it's big. I mean, it does paint a picture that economic momentum has slowed. So,
or the brakes have slammed on. It looks like to me. Okay.
That's right. At a time when we know even businesses are saying that they've gotten cautious because they don't know what to do with tariffs. So that's why if you look at the markets, they're pricing in a growth slowdown from tariffs, not inflation.
So Tom here is really hitting on a solid point that I've been saying a lot recently too, in that it doesn't necessarily make any sense to jump the gun on saying that these tariffs are going to be incredibly inflationary just yet. At one point, we saw kind of this game of cat and mouse where these tariffs were getting put on, they got rolled back, but we didn't have any of those tariffs just yet. Now we do, and there's a very, very different phenomenon happening in the market right now. The first is this. This is the chart of the 10-year Treasury yields. Remember, if the market was actually worried about inflation and the devaluation of the United States dollar, we would see 10-year Treasury yields moving vertically, almost like we saw in the month of December and really heading into the first 2 weeks of January 2025. But what they are starting to look at now is the actual effects and implications of what these tariffs could potentially do to the U.S. economy moving forward. Now, we're going to go over the reasons why this is taking place too, because if you can understand, like I said before, that story of the landscape that we are in right now, it makes it a lot easier to make better decisions in the market and to, again, really be able to stomach some of this short-term volatility. So, the first thing that we had seen recently was this significant downward revision or downward projection in the Atlanta Fed GDP Now real GDP estimate for the first quarter of 2025, which is now sitting at about -2.4%. Remember back a couple of years ago when we had those 2 declining quarters of GDP, we were all talking about, okay, well, that's the textbook definition of a recession. And then all of a sudden the talking heads really just came around and changed the definition on us. Well, this is what the market is worried about right now. Economic slowdown. So what could those implications actually be? Well, when we take a look from this study that was done by Yale recently, what could these effects be in the first basically 2 years of this administration? if things do not change from where they are currently right now, especially as it relates to the federal funds rate and the Fed's guidance going forward with what they think they are going to be doing with interest rates. Well, this is a very, very steep drawdown here. They're talking about limited retaliation from these tariffs, full retaliation from these tariffs, and that's really where a lot of this scare is coming from. If the United States, again, we are a net importer, and if you've read anything about Triffin's dilemma and our deficit or anything of that nature, you know that that has to stay the same if the dollar wants to maintain its status as the world reserve currency at this current time. But when you take a look at this chart here, if the kind of median projections right now are that GDP and growth of the United States economy is either going to stop or start to shrink, well, that is obviously not going to be good for markets in the short term. But there is a little bit of a silver lining here, because again, when we are looking at this environment right now, guys, things are moving very, very quickly. We are seeing tariffs get put on. We are seeing tariffs get put off. We're seeing negotiations happen. But what you have to kind of start to understand is, where are we in this big picture right now? And I think when we start to move over here, this starts to give us a little bit of a bigger picture. There was a survey done right here, the Bank of America Global Fund Manager Survey. What do they think the most crowded trade was? Long Magnificent 7. Now, we've talked a lot in the past about the unwind of the carry trade and all the leverage that is out in this market right now. So, mainly due to the fact that the market has basically done nothing but go up in the year 2024. We saw a very, very, very strong market, and the concentration risk was very high. And what I mean by that is that if everybody is all buying the same thing or holding the same things, as soon as one little thing starts to happen, you see everybody try to get out the door at once. And that's why when we take a look over here at the Mag 7 ETF, this has seen a very, very significant drawdown from the peak back on that first rate cut day, which or the last rate cut day that we saw, the hawkish cut, which we're going to be talking about a little bit here as well. 21% drawdown in this Mag 7 ETF. Now, in order to really understand the big picture here, guys, you have to have a really solid understanding of where we are as a country, how much debt is out there, what has happened over the last 5 years here that is different than some of the periods prior. One of those things is the fact that Janet Yellen decided to issue a significant amount of government debt with very, very short times to maturities, 1 year, 2 year, 6 month, that type of short time frame. And the reason why she did this back in the COVID era there was because they were trying to get the lowest interest rates possible. Now, they could have sold 10-year treasury yield, 10-year treasuries below 1%, but they chose to sell even shorter maturities. And the problem that causes is that you have this debt roll up every single year, and the government needs to continuously refinance that debt. Now, if we just take a look here, it's not going to be as big of a difference as it was before, but the 10-year treasury yield is currently trading at 4.225%, and that is an annual rate here. And when we take a look at the 2-year yields, let's just say, these yields are notably lower, 3.9%. So if these shorter duration yields are lower than the longer duration yields, well, this creates a problem that every single time this government debt comes due, they then have to roll it out to shorter expirations. So when you hear Donald Trump talking about the fact that, oh, we're broke as a country, these tariffs are going to make us rich, it may not actually be the tariffs that end up doing or having somewhat of a longer term benefit on our economy, but it is this right here. When we look at the interest rate projections, we talked about this in the last video, that we were seeing the rate cut odds for more rate cuts coming a little bit sooner starting to step up. Now, again, when you see those growth slowdown expectations starting to rise, obviously there's going to be some additional bets taken on the Federal Reserve starting to cut interest rates a little bit sooner. And we can see that right here. From just Friday into today, we have seen the projections for about 100 basis points, or 1 full percentage point, or 4 25 basis point cuts in 2025 go from 20% odds to 28.1% probability. You are seeing the market starting to have this little bit of a flight to safety situation here, where they're starting to look at everything and say, uh-oh, if the economy starts to slow down, the Federal Reserve is going to need to step in and lower interest rates. But one of the good things about where we're currently sitting with the federal funds rate is we're not at 1%. We're not at 1.5%. We're not at 2%. We're at, the current target rate is 425 to 450 basis points. If the Fed deems it necessary, which is very possible that they do, to start lowering interest rates a little bit faster than expected, they have a lot of room to come down. Now, I don't want everybody to think that we're sitting in this video here. Oh, and the one other thing that we do need to talk about, kind of on that debt rollover, there are some different expectations out there and projections. It could be 8 trillion, it could be 9 trillion, but the sources that I'm seeing there are a little less reputable. Really what we're seeing here is about 3 trillion of US debt is expected to hit maturity in 2025. So the US government is obviously going to need to reissue that debt, take that money back in, and then have a new interest rate going along with that. So we do have a lot of this debt maturing, and that needs to get rolled over this year, which is why this is a problem and why they want interest rates to come down. That's just one of the reasons, though. Obviously, if you were to see interest rates come down, more capital can flow into the economy. You can see companies grow. A lot of benefits will come in the long run by having interest rates a little bit lower, especially government bond yields. But we are going to play another clip from Tom Lee right now that is going to go through this a little bit more in depth, because remember how I said before, there is a lot of moving parts right now and things are moving very fast. We do not necessarily know what the outcome or what the market or the economy is going to look like in the next month or so here. We have CPI coming out Wednesday, and then PPI also this week. So we do have that inflation data coming out for us. But this clip from Tom Lee here is going to give us kind of a little bit of a potential light at the end of the tunnel here.
Is that the big risk here?
If the trajectory of earnings is impaired, that's different than if you're delaying, you're taking a 2-quarter hit because of the tariff uncertainty, and stocks might go down on both, but one's a huge buying opportunity, right? Because if you're just talking like a 2-quarter blip on earnings, but then everything goes back to normal after that, then we've created a huge buying opportunity.
Is that your assumption that that's going to be the way this ends up going?
I'm almost positive, because we've been comparing Trump 1.0 to Trump 2.0.
And that right there, guys, is very, very big and very significant. If we end up seeing a little bit of a downturn in the short term, only to set ourselves up for a significant rebound, that is probably the best case scenario for almost every investor in the market right now. We have gone through a period, and let's pull up the chart of the S&P 500 right now. This is ES, the S&P 500 futures. When we look at this chart here, guys, and we go back from early 2024 and we see the significant move up that we have had, this is potentially providing one of the best buying opportunities that we have seen maybe since kind of the situation that we saw back in kind of the later summer months when we saw the unwind of the yen carry trade. Or quite honestly, if this fear continues and we trade down to these lower levels here, 54.30 in the market here, it honestly could be one of the best buying opportunities since the pandemic. So, but again, I don't want anybody thinking to doom and gloom or to, oh my God, the market is about to bounce. I tweeted this out earlier today that you do not want to be trying to catch the falling knife in this environment. For those of you guys that know, one of the main things that I look for when I am looking to establish a new position is a base. It is better to buy the base and break, and it is always better to be a little bit late than it is to be wrong. Because if we start buying here in the market and the market continues lower off of some maybe adverse economic data, some earnings that come out that are not what the market wants to see, some even more elevated volatility due to this trade war, that is going to put your portfolio in a position that it doesn't need to be in. Patience pays in the market, guys. Again, nobody's going to time the bottom, but there are ways to maximize on these types of moves to the downside here. So that is going to wrap up this video here, guys. If you did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading this information out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys hit that subscribe button, turn on those notifications, and I'll see you in the next one. Peace.